Warren Buffett is selling stocks on a large scale. Corporate insiders are breaking records with extensive sales. U.S. interest rates are at historic highs, and the U.S. economy is potentially on the brink of a recession. Yet, at the same time, U.S. stock markets have recently reached new all-time highs. Are we on the verge of a major market crash, or are stocks still a worthwhile investment? In this video, we deeply analyze the current data to shed light on this question. One particularly concerning indicator is the so-called Warren Buffett indicator, which Buffett identified in 2001 as his preferred measure for assessing the valuation of U.S. stocks. This indicator has now reached a new record high, similar to levels seen before the dot-com bubble burst in 2000 and the bear market of 2021. The indicator currently stands at 200%, a level Buffett once described as playing with fire. But is the U.S. stock market truly overvalued? Or have the conditions changed so significantly over the past 25 years that the indicator should be interpreted differently today? The Buffett indicator measures the ratio of the total market capitalization of U.S. stocks to the gross domestic product. With this new peak, the indicator surpasses the previous record high of 197% in November 2021, which was followed by a year-long bear market. Today, we face similar challenges, but the economic landscape has shifted drastically. Higher profit margins, a greater concentration of assets in the technology sector, and increasing globalization all contribute to a higher market capitalization relative to GDP, potentially skewing the Buffett indicator. Comparing the current market with previous phases, it's clear that applying the same standards is naive. The proportion of international revenue for S&P 500 companies has risen from 29% in 2000 to around 40% in 2020, distorting the Buffett indicator as global earnings are not accounted for. Today, large technology companies like Apple, Nvidia, Microsoft, Google, Tesla, Meta, and Amazon dominate the market. These companies have a massive global presence and significantly influence the total market capitalization of U.S. companies. Their rise has been driven by high growth rates, increasing profitability, and positive future prospects. These firms have also triggered a structural shift in the economy, further amplified by the AI revolution. Given these developments, the Buffett indicator could be sending misleading signals about potential market overvaluation when used in its traditional form. It doesn't account for the changing composition of the economy or the global revenues of U.S. companies, which may lead to an overestimation of market valuation relative to the domestic economy. Another important detail: the average net profit margins of U.S. companies have nearly doubled since 2000, from around 6 to 7% to over 12% in 2023. Higher margins mean companies generate significantly more profits at the same market capitalization, leading to lower price-to-earnings ratios. This suggests that a higher market capitalization relative to GDP is justified today without necessarily indicating overvaluation. If Buffett identified an 80% ratio as an attractive buying level in 2021 with doubled net margins today, this threshold could now be around 150%. So is the market not overvalued after all, and has the recent 15% correction brought it close to this 150% level that Buffett would consider highly attractive? But why, then, did Warren Buffett sell half of his enormous Apple stake, which made up about 50% of Berkshire's portfolio? And why have so many corporate insiders sold stocks at unprecedented levels? These questions and more are explored in detail below. Insider sales on a broad market level are a complex indicator that can't always be clearly interpreted. While extensive insider sales are often seen as a warning sign for the market, there are numerous reasons for such sales that have nothing to do with a negative market outlook. After significant market gains, many insiders take profits since their salaries and bonuses are frequently in the form of stocks and options, which they convert to cash at high prices. Therefore, insider sales should never be used in isolation as a basis for predicting market developments. They are just one factor among many that should be included in a comprehensive analysis. Warren Buffett has also sold more stocks than he has bought for 7 consecutive quarters, leading to a rising cash balance. In the second quarter of 2024, the sales surplus was an impressive $75 billion. This large number, however, is mainly due to Berkshire Hathaway selling half of its massive Apple position for nearly $80 billion. Aside from this, Buffett hasn't significantly increased his selling relative to buying. This activity should therefore be viewed in the context of the large Apple sale and is not necessarily a sign of a pessimistic market outlook. Our analysis confirms that media reports about the Buffett indicator and a potential crash are greatly exaggerated. Insider sales in well-performing markets are common, but do not necessarily indicate an imminent downturn. This metric can change quickly. Warren Buffett shows us the way. He continues to buy stocks, but very selectively, focusing on undervalued top brands. With strongly performing stocks like Apple, however, he also takes profits and leverages the attractive interest rates on U.S. bonds to park hundreds of billions of dollars risk-free. Other major investors follow a similar strategy, cashing out on stocks like Nvidia and Meta while reinvesting in potential laggards. The Buffett indicator now clearly needs to be reevaluated. A level of 150% might already represent a good entry point, as the price-to-earnings ratio at this level is comparable to that of 80% in 2001. Some experts are also beginning to see 150% as a fair level. The recent 15% market correction has normalized the Buffett indicator somewhat, bringing the market to a more reasonable valuation and opening up new selective buying opportunities. Historically, the S&P 500, following the bull market cycle, has realistic potential to multiply in value over the next 10 years. Stay tuned, because in the next linked video, we present the top turnaround stock for 2024-2025, which stands to benefit greatly from the U.S. interest rate pivot. Also, don't miss our upcoming video where we'll introduce the top stocks, like Buffett's recent value purchase, Ulta Beauty, that perfectly fit his investment criteria. Be sure to subscribe and activate the notification bell to get alerted on our latest top tips.